All right, guys, what's going on? John Fibonacci here, coming at you with a special video today. We've been saying over the last couple months, we've been mentioning open interest, right? And I think we've mentioned seasonality before. So this video is basically going to give you a better understanding of what open interest actually is and how we use it to our advantage to call really explosive moves in the market. So this is not something that we are going to be able to day trade with. This is like the whale trades, right? You know, those like 1,000 pip moves, 2,000 pip moves, stuff like that. And yes, we've called them before. You know, it's not unheard of. It's just very, very rare. Okay, unless you trade US 30, right, on the daily. Anyway, so what we're going to have to do, guys, is really go through the definitions. Okay, we're going to have to read a little bit, but I promise it's going to be worth it. So at the end, once we get to the examples, okay, I promise you're going to have to pick your jaw up off the floor because you're just going to be like that captivated by this information. I was, okay, and I know you guys will be as well. We got to start with definitions, right? We got to understand what the data is, you know, how we get the data, who we get the data from, and why. Okay. So, again, you know, we always give credit to our sources. Okay. So, we're going to investopedia.com, right? You're no stranger to that website by now, which you can look up everything that we talk about, right? Commercials, smart money, institutional investors, all that. Right now, we're on Commercial Trader. And these are the most important folks, all right, when it comes to open interest. So, who is or what is a commercial trader? It's a trader who trades on behalf of a business or an institution, right? There's that I word, right, that we love so much, institutional trading, right? So, in the commodities market, the CFTC has a special classification for commercial traders and describes them as traders that use the futures market primarily to hedge their business activities. I know that sounds like a little mouthful because it is, but this is the most important part that you have to understand what they are, who they are. They're traders that use the futures market primarily to hedge their business activities. Okay, so they're not speculating. What we do, retail traders, we are speculators, right? We take on the risk in order to get a reward. In the commodities market, a lot of businesses are not in the business of speculating. They're in the business of, you know, whatever business that they're in, and they want to protect themselves from market fluctuations. Now, if the price of what they're selling goes higher, could they make more money? Well, sure, probably. But they don't want to take the risk if the price goes lower, right? Then they eat into their profits. So they hedge the market. So whether the market goes up or down, they're not going to lose or gain very much at all. So what they lose in the price of the asset, they're going to make back from their business, and vice versa. If they lose profitability from their business, they're going to make the money back from, guess what? The futures market. Now, obviously, it's not going to be exact. They might lose a couple thousand, but it's not going to be like hundreds of millions of dollars. Okay. Anyway, yes, that's what commercials do. That's their job. Now, again, you can go back and read this, which I highly recommend, okay, because you're going to get a little bit more detail. You know, obviously, I'm not going to read to you everything here, but there was one more right here, this last paragraph. Many traders view the commercials as the smart money, right? You've heard that before. Smart money. Since the commercial traders are working in the actual commodity industry and have insights into how that industry is doing based on what they see happening in the company around them. This essentially is insider information, right? Now, insider information is totally illegal. Okay, I'm not saying that. This, I said it's basically, right? It's very close. This is all government regulated. CFTC, right? They don't play around. But these are the people who run it, and they run the COT report as well. So if you think about it, and this probably isn't the best analogy, but it is what it is. If my car breaks down, which I hope it doesn't, knock on wood. Am I going to bring my car to the doctor's office? Or am I going to bring my car to a mechanic? Right? It's obvious that I'm going to bring my car to a mechanic. They know cars in and out. They work on cars every day, right? The doctor's office, they work on people. They don't really care about cars. So if I want to know what's happening in the automotive industry or in the car repair industry, I'm going to go talk to them too, right? Because they're the smart money in that field. That's who the essentially smart money is. That's who the commercials are. Now that we understand who they are, we have to understand how they report. So basically, they report to the CFTC, like I said, and they plot COT, but they also plot open interest, also known as OI. That's the short term, right? OI, open interest. Okay. So, what is open interest? It's the total number of outstanding derivative contracts, such as options or futures, that have not been settled for an asset. The total OI does not count and total every buy and sell contract. Instead, OI provides a more accurate picture of the options trading activity and whether money flows into the futures and options market are increasing or decreasing. Isn't that kind of what we want to know? Whether money flows into the futures and options market are increasing or decreasing. Where's the money? Where have you heard that before? Right? Where's the money? That's our number one question because that's where the market's headed, right? So we look at open interest to see what the commercials are doing. Are they putting money in? Are they taking money out? Right? And obviously, we go from there. And again, like I said earlier, go to Investopedia, open interest, and go read the rest of this. Okay. It's going to give you a much better detailed explanation. All right. So now we're going to take a look at some open interest. Okay. So the way that I do it, and it's totally free, and you could probably get it on TradingView or another website. I don't know what you guys use. Okay. But personally, this is how I do it. So I'm going to walk you through it. This is barchart.com, very easy. At the top, right here in the middle, they're actually going to have select a commodity. Okay. So this drop down menu is going to give you a whole bunch of stuff to look at. So at the top, near the top, okay, we have our metals list, right? Gold, silver, palladium, all that. What we're going to be doing is taking a look at the silver market for this video's example. Okay, and you're more than welcome to go look at everything else on your own. All right, but for the sake of time, we're just looking at silver today. So after you click on silver, okay, what you're going to see is this giant list of the different contracts and their delivery months and the delivery year. Okay, that's why all these have different prices. So you have the cash market, and then you have right here, it says March 20. Okay, the 20 is the year, and the month obviously is the month, right? March of 2020, April of 2020, right? So when we come down here to January, this is January of 2021, so almost a year out, right? And then it goes further from there. So what I do is I don't look at the cash market. Okay, I look at the next delivery month, or on TradingView, it would say continuous contract in front. So again, it's not the first one, it's the second one. Okay, for March of 20, because we're in March right now. So next month, right, once March is over and it's April 1st, right, April Fool's Day, right, April would be right here. So what we're going to do is click on March of 20, and then it's going to give us this. I don't like looking at this, so I'm just going to go straight to full chart. Okay, so we're just going to click on full chart, and it's going to bring this up. Now, we were on this call a little bit earlier, so this is a little bit different, but what you're going to see right here is volume. In order to change that and to put on open interest, what you got to do is come up here to plus study, and then you're going to get this menu that comes up. What you're going to do is click on volume. Okay. And when you click on it, your volume is going to have the Illuminati eye on it, right? As does OI. What you're going to do is uncheck the I. So that way we don't look at the volume because we don't care about that. We just want to look at OI. Okay. So when you apply it, that's why mine looks just like this. Okay. So also what we got to do, last step, okay, is we got to look at our prices and then we got to warp it a little bit, right? Because it's too flat. We want to see the nice peak and troughs, if you will, the nice up and downs, okay? Because that's what's going to be important. So this chart right here is very clean, despite the grid. I can't stand grids, but I can't figure out how to change it, and I'm not going to do that on this video. I'll do that another time. What open interest is, right? We went through what it is. When you understand open interest, when it's dropping, okay, when open interest is going lower, that means the short positions are decreasing, right? They're decreasing short positions. Now, when the line goes higher, that means they're increasing short positions. Okay, so for you note takers, you may need to write that one down. You may need to pause the recording and go back 30 seconds and watch it again, whatever you got to do. Okay, shorts decreasing as it goes lower, shorts increasing as it goes higher. So that's how you know what the commercials are doing. That's how you know what smart money is doing. Now, do we see that in the charts? Yes, we do. But now we can confirm by the actual orders on the futures market. Okay, now we're confirming it. But now, in order to for price action and open interest to complement each other, you would first look at open interest, decide what commercials are doing, and then go into price action to confirm. I wouldn't do it the other way around. Like I wouldn't start with price action and then go to open interest and try and form fit it. I wouldn't do that. Okay. Commodities are a little bit different than Forex because commodities also have are really big on seasonality, which we're not getting into yet. We will. We'll get there, I promise. But we're not going to get there yet. But I'll give you a little secret. Commodities, they either trend in one direction for a long time or they consolidate for a long period of time. Okay. And you can backtest that in the charts. All right. But now we're going to get into some explosive moves and how you were able to see them days or even weeks in advance. Okay. And that's how I was able to call the bottom for gold and silver the last 4 years in a row. Okay. And I know a lot of you haven't known me that long, and it's fine. You just have to take my word for it. All right. Anyway, so let's get into it real quick. I'm going to have to pull up the box tool. Okay. So this is what I want you to look at. I want you to notice the low that was set. Oh, that's not a box tool. That's a line. Sorry about that. What I want you to look at is this price action right in here, right? We had a low set at a little bit above 14, and we had a high set near 19, right? That's a very large swing on the silver market, right? That's a lot of pips. So how would you have known the market was going to explode? Well, I'm not getting into price action just yet. Plus, I've got more examples, but I'm just walking you through this, okay? When you realize that essentially the market was consolidating, and I know that box is a little bit off, just bear with me here, okay? When it started to break out, right? You guys can see that. It was this breakout right here, right? That's a higher high, is it not? Market's going higher. So look what happens when price retraces. Obviously, price is retracing. We know that, but look what open interest is doing. As price makes that high and it's retracing lower, they're decreasing short positions. Oh, that's important. Like I said, decreasing their short positions. So if they're lessening their shorts, what do you think that means? That means they expect the market to go higher because they're taking short positions away. So what happens after the market retraces, makes that low? You get your price explosion. That's how you know that. Okay, so there's one really nice example of open interest. Okay, moving forward and still looking at the other side of this screen, what do you see right here? You get a very large drop in open interest. That's what's important. It's not just normal decreases or increase in open interest. It's usually 10 or 20% drop or more. Honestly, I just eyeball it. I really don't do the calculations. That's just me personally. If you want to do the math, that's totally up to you. Anyway, moving on. Open interest, right, decreases very quickly, very rapidly at this point, right? So what does the market do next? Rallies from what is that? Mid 16s up to maybe high 18s, right? That's a very big swing. Guys, this is a daily chart. Okay. This is a daily chart we're looking at. So this is, a couple of weeks worth of up movement completely. How do we know? How did we know? Well, I didn't call this out. I don't know if one of us did or not. Let me clear this out for a second. I just want to zoom in. Check this out, right? It's obvious that February 24th of this year made a high on silver, and we went from 18s all the way down to 12. Why did that happen? Well, what did open interest tell us? Let me pull out the box tool again. Actually, I don't need the box tool. I'll just do the regular drawing. When price was increasing here, so was open interest. It means they were increasing their short positions as price was going higher. Okay. And then the market took a very, very hard plunge. And then also gold and silver diverged as well. That you're not going to see on this chart. Okay. And if you haven't seen any of our divergence streams, you got to catch up on that. So you just, again, here, you just got to take my word for it. But yes, there was more than one tool that was telling the world, the market was telling us that we were either going to have a really big movement higher from this drop in open interest or a really big move lower from this increase in open interest at a logical area. So now what I'm going to do for you is show you some more examples that I've already got marked up. So I'm saving you a little bit of time here. Okay. So hopefully you guys can see this a little bit better. I've already marked up the boxes for you so you can see what the market did at what time. When open interest dropped very rapidly here, they decreased many of their short positions. When they decrease their shorts, they expect the market to go long. The market reverses. And so on and so forth. Okay, so this is actually the US dollar index. There's some Forex for you, right? John, I don't trade silver. I trade euro and all that. Okay, well, here's dollar index. Let me go to GBP, right? British pound. You can see some very large swings that occurred, right? And I know some of you weren't trading maybe in March or May of 2018. So, we didn't have that opportunity to, to hold a trade for a whole year. I don't trade that long, but this is just further proof that open interest commercials can move the market in one direction for a very long period of time. Yeah, there is your British pound. Here is Japan yen, okay, JPY. I don't know why that's smaller versus the other ones, but here it is. Drop in open interest, and it rose pretty rapidly. I don't know why I've got the down arrow there. Uh, that was silly. The decrease in open interest here led to this really big rally on the yen. So that will pretty much cover it for open interest. Oh, I've got one more on S&P 500. And I've even got some notes. Don't forget to include divergence because that would be able to help you as well. So there you have it.